Okay, hi, this is Mayor Valensky with Driving Markets. Okay, so today you had unemployment numbers come out in the US and they came at 261,000 claims. That is much more than the 235,000 claims that they were expecting. Now, what you've got here is you've got a situation whereby one of the fundamental foundations of a strong economy is full employment. And if you've got rising unemployment, and that is going to be a problem. One of the things that's held up the global economies since COVID-19, when the lockdowns were released and people were let out, was a huge demand of labor. And that's been consistent with very, very low numbers of unemployment in each of the jurisdictions, whether it's Europe, whether it's UK, or whether it's Canada, or whether it's US, Australia. You've seen globally massive demand for labor. Several reasons for that. The main one is that there was a change in lifestyle. Number two, there were lots of people unfortunately passed away during COVID. A lot of people just gave up their regular jobs, a lot of working from home, and just a complete change of culture. And that caused a huge shortage in certain areas. For example, airline pilots and tourism, hotels, the service industry was sucking in all the available manpower. So when you've looked at the US non-farm payrolls, jobs created, they've just been going up and up and up. However, I've been stating for a while that those numbers, in my opinion, are manipulated. You've got rising unemployment. You've got a general recession overall in the economy, even though governments are denying it. In fact, in Europe, they've just come out officially and said there's another fourth quarter of downward growth, negative growth. So Europe is in a recession as such. However, in the US, they're reluctant to state that they're in a recession, quite simply because that would put the panic or would put hysteria within the economy. There is already a feeling of a downturn as far as the US is concerned. Not so much, even in the high-tech sector, there is a downturn. However, because the markets are very strong and because the NASDAQ is moving up significantly, then a lot of people are ignoring it. However, when you look at the man in the street and the small business, they are suffering, and that is coming to bear now through 2023 and 2024. You will see rising unemployment. So what's the impact of rising unemployment? Quite simple. There's going to be an increase in the default rate on mortgages, on loans, on car loans, credit cards. People are going to spread out the payments and people are going to cut back significantly, because when you don't get your pay slip or you don't get your wage check or your salary paid into your bank and you're now unemployed, then that makes the whole consumer confidence drop significantly, and that's going to impact overall on the economy. So what you have now is rising unemployment, and you will see that markets will start to tick down. Since January, from the lows of December 2022, markets have gone up, obviously on the vision or the hope of lower interest rates and lower inflation. But if we're looking at interest rates, there's already 3 countries just in the last month that have raised, or last 2 weeks, they've raised interest rates significantly. New Zealand, out of the blue, raised interest rates. Canada raised interest rates just yesterday, and Reserve Bank of Australia on Tuesday. All of those 3 increases, which were 25 basis points, were out of the blue. They weren't expected. And now with the US FOMC having on the 16th of June, having their meeting, the odds are that there will not be an interest rate rise in June. I also really don't believe that the US is going to raise interest rates. However, there is a 30% chance that they could raise interest rates, and we need to be prepared that this could be a 25 basis point rise out of the blue in the US on the 16th of June, following on from Canada, which is its neighbor, New Zealand and Australia. You've got the UK likely to raise interest rates also by 25 basis points, putting more pressure on mortgage holders. So we are in an environment of rising interest rates and tighter liquidity. And when you have rising interest rates, tighter liquidity, then that is going to impact and going to affect people's spending habits. Now, moving on to inflation. Inflation has dropped and has consistently dropped since January. However, I believe that inflation now is going to tick up, especially food inflation and core inflation, which is not coming down. So we're going to see headline inflation also start to tick up. And I think that New Zealand, Australia, Canada are aware of this. And I think America, the US, is also going to be looking at rising inflation over the next 18 months. So I don't think we're going to be dropping anymore, falling anymore when it comes to producer price index or retail price inflation or personal consumption expenditure, which are the measures of inflation. I think we're going to see rising inflation over the next 12 to 18 months. That will impact, obviously, property prices. Looking at some of the asset classes, you've got very, very quiet on foreign exchange markets. Again, you've got a bit ticking up of the dollar, which I've spoken about already for several days. You've got Bitcoin, which went up to 27,200. It's come all the way back to 26,300. It's going to be testing the 25,000 level. My opinion is if it drops below 25,000, it is going to go down. But those who are traders could accumulate and could start picking up some Bitcoin if you fancy it. That's more or less it for now from Maverlandsky Driving Markets. Just to let you know, I published my first book on Amazon. You can find it there under Kindle or Amazon. It's just published yesterday. And if you can subscribe, share, comment on my YouTube channel. If you need anything, happy to help. Have a good day.